Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services and also the brand ambassador for the Retirement Income Store. Right now, it's time to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff's also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. But we also want to bring in our first guest, a good friend of the income generation, Harry Dent. He's the author of 0 Hour and the editor of Economy and Markets, a free newsletter available at harrydent.com. Harry, thanks so much for being back with us on the show, and Happy New Year.
Yeah, glad to be here, David.
You're right. We are pushing on a string, and that string is getting really, really thin. But looking at the market charts today, I mean, it's clearly we're in a bubble. Valuations are stretched. We're going to face some challenges going forward. And now we've got this new political theater action going on. It looks like the Senate's going to be blue.
Well, you know, what's happening now, and this is why the market, I mean, we're talking on Wednesday here, and we get this news of 2 Democratic senators likely, you know, coming in, which is going to take away McConnell's power substantially. And what do? The NASDAQ is down 1.5%, 2%, and the small caps, the value stocks, are up 2 to 3%. Well, it's saying we're switching more from monetary stimulus, which favors all financial assets, especially the most highly valued, which means the tech stocks, and into fiscal stimulus, which actually goes into the economy and the consumers and businesses rather than just into pumping up financial assets. So that's the shift here. So the Democrats think, okay, yeah, we're going to get more fiscal stimulus, but the Fed is going to use this as an excuse.
Going back to the pushing on the string type theories, you know, I see us going forward in the economy using a China money management or financial engineering style of just money printing endlessly. We're going to open up the checkbooks. They're going to buy equities if the market crashes. They're going to keep interest rates low. How can the government ever raise interest rates? How can the Fed ever raise interest rates when there's this much debt? I see interest rates being low forever.
Well, they're going to do it until the markets raise interest rates because of default risk, first in business, and then at some point. I'm projecting in my most recent newsletter a $40 trillion government debt in the U.S. by 2024, because we just had $3 trillion, add $4 trillion a couple of years, and after that, this happens quickly. So the markets will take care of this. But near term, interest rates are going up a little bit. Late stage inflation on the treasuries, 10-year and 30-year treasury, which is important because that is the safe haven in the downturn. It was in 2008. It will be now. It will not be gold. Gold will go up at first. But when you see deflation and companies failing like Lehman Brothers in mid-2008, interest rates are going to go down, Jeff, because of deflation in prices, negative consumer price inflation, not just because of stimulus and buying bonds to push their rates down. So I see the 10-year maybe going up to 1.25 here. It's already up above 1% on Wednesday here, and then going down to 0 or negative 30 years from 1.7 or 8 down to 0.5% or lower. And people say, well, how can you make money on a bond that low? A 30-year treasury bond, if it goes from 1.7 down to 0.4, which is my best calculation, will appreciate 40% while stocks and everything's crashing. In the one thing the U.S. government will make sure to make their payments, they will not screw their own bonds, okay? They'll let the stock market crash, but they're going to pay off their bonds short-term and long-term. And those rates are going to go down and favor them for a while. So this low interest rates is artificial, but we're also in a longer term era of low inflation because of slowing population growth here and around the world. So even when we go in the next boom, we're not going to see inflation go up to 15% again. We might see inflation get back up to 2, treasury bonds up to 3 or 4.
Harry, it's been our pleasure. It's great to get your views as usual. And thanks so much for being back with us here on The Income Generation. Now it's time to bring back in my good friend and co-host, Jeff Small, as well as another good friend, Dave McAdams, president of McAdams Group, a retirement income store located just outside of Memphis. Dave, thanks so much for being back with us here on The Income Generation. What's the sentiment that you hear from the folks in Memphis? Are people pretty optimistic moving forward, financially speaking, or how are they feeling?
Well, that's a coin toss. It depends, because you have both sides. You have the people who are, basically fear-based. They're concerned about what I would call legislative risk. They're concerned about rising taxes. They're concerned about losing jobs overseas. They feel like a recession's imminent. And then you've got the eternal optimists. You got the people who just believe that no matter what happens, the stock market will keep going up, up, up without any repercussions. So I'm hearing both sides. If you're asking me what I'm hearing from clients, there's the polar opposites is what I'm getting.
Yeah. So Jeff, which camp does Harry Dent fall into?
Harry Dent falls into perma bear camp, because he's constantly predicting every year when the market's going to crash and what happens. And
he falls into his own camp. That's right.
He falls into his own camp. So Dave, I'm starting to feel like my taxes are going to get increased. Are you getting that feeling? Because I think this blue wave is going to become reality shortly here. And so what?
I agree with you. I agree with you. I've been consulting with clients on tax issues going into the end of the year. And one of the things I've been saying is you're probably likely never to see taxes this low for the rest of your life. We had some people that were trying to rush to get some capital gains and some assets sold in 2020 just to take advantage of the lower capital gains rates, which are likely to increase with. And that's why I was referring to the legislative risk. I do believe that taxes will be higher. I don't know when they're going to implement that, but they've even been pretty blunt in saying they're going to be raising taxes. So absolutely, I think that's definitely on the horizon.
And
go ahead, Jeff.
By raising taxes, if they raise corporate taxes, do you know what that does to the market charts we've got already? It makes them look worse because the earnings ratios drop because now corporations are paying more in tax and keeping less profit. And so that makes stocks look even more overvalued, Dave.
Well, I'm going to have to agree with you. I think economic policy, when you look at the different things that the government can do, one thing they can do is lower interest rates. But the other thing they can do is implement economic policy. Now, normally that takes a little bit longer to sink in as far as having an economic impact. But to your point, if we raise corporate taxes, you'll probably see corporate funds expatriate. Famously, companies like Apple and other companies had billions of dollars sitting in Ireland just because of the corporate tax rate. They repatriated that money after the 2017 Tax Act. But I would expect that to leave again. I would expect to lose jobs. And I would expect to have lower wage migration. Less increases in wages means less money in people's pockets, which means fewer corporate earnings. All of this does not bode well for stocks having a unlimited run.
What do you think about interest rates, Dave? You just brought up a really good point. 0% interest rates were the reason for the bull market the last 10, 11 years. I see rates staying low for a very long time. I don't see them really going within a 100 basis point range plus or minus from here, because the government debt is just too large. We can't afford to service that debt. But debt maximums are reached everywhere in corporate America and with the federalized deficits globally and domestically and with consumer debt. So where do you see rates going in the future?
I agree with you because, when the Fed comes out publicly and says we're not likely to raise interest rates for at least 5 years, translation, that could be much longer than 5 years. I remember back in 2009, the Fed chairman at the time said they were going to raise interest rates by April of 2010. Not only did they not raise interest rates in April of 2010, but 7 years later, they raised them a whopping 0.25%. So you can't always listen to what they say or believe what they say. But when they're bluntly saying they're going to keep interest rates at zero for at least 5 years, my translation is possibly 10 years or longer.
As usual, fantastic advice. Thanks for joining us.